ChargePoint stock is down almost 94% off its high in the previous 5 years. And hopefully you've been watching my channel. And before that, I was writing articles telling investors to avoid this overhyped electric vehicle stock. For years and years and years, I told investors, avoid this stock, do not buy this stock. And to start 2025, I had ChargePoint on my list of stocks to avoid or stocks that I had rated as a sell. And there were only about 4 or 5 companies on that list. And ChargePoint was one of those companies on that list of over 200 to 300 companies I have ratings for. ChargePoint was on one of only 5 that I had rated as a sell to start 2025. Needless to say, I was not optimistic about this company. That being said, 1 month ago, I upgraded ChargePoint stock. I placed the company rated as a hold up from being rated as a sell. And my reasoning was that the worst was behind it. And following the developments of the big, beautiful bill in the United States, where EV tax credits were being removed and the stock price was already beaten down by so much, I felt the worst was behind it, and it was no longer a stock that was in a situation where I felt like it was worth to just dump and avoid. So in this video, I'm going to update my recommendation. I'm going to update you on what's going on with ChargePoint stock and let you know where I stand on this company.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. In their most recently completed quarter, ChargePoint said that revenue came in for the first quarter at $98 million. This is Q1 fiscal year 2026 for ChargePoint. Revenue came in at $98 million, right within our guidance range. Non-GAAP gross margin continues to increase quarter over quarter, reaching a new high of 31%, with software as a subscription gross margin coming in at 60%. First off, let me highlight something that management teams like to do. Revenue came in at $98 million. You notice they didn't talk about whether or not this was higher or lower from the same quarter last year. Typically, when revenue is higher than where it was in the same quarter last year, the management team will tell you that. They will say right up front, revenue increased by so-and-so percentage from the same quarter last year. I was just reading the conference call transcript from CoreWeave, the AI company, and their revenue increased by over 200%. And so management was advertising that fact all over their earnings call, right? But what do you notice missing from ChargePoint's earnings call? No discussion about whether this revenue was higher or lower from the same quarter last year. So a lesson to investors following. Management teams will always try and point your attention and highlight certain things about the company they want you to focus on. When there's numbers that are unfavorable, they will not highlight them. They will not share them with you. They will allow you to dig through the details to look for that information before you actually find that information. ChargePoint added new facilities, opening over 500 additional ports signed off by GM for deployment. So this partnership with GM has been a success according to ChargePoint's management team, and this will help the company achieve greater deployment of their electric vehicle chargers. Remember, in the United States, less than 1 out of 10 people are choosing electric vehicles, and since the announcement that on September 30th, we will remove the tax credits here in the United States for purchasing EVs, I expect sales of EVs to slow down further still. It's mostly unattractive for people here in the United States. It makes sense for less than 1 out of 10 people. There is a small percentage of the population where an electric vehicle makes incredibly good sense, great value for those people. But those people are a very small fraction of the overall population, of the overall car owner population. And so it's failed to gain momentum here in the United States. And I don't expect it will anytime soon unless there's a big change in the technology. For instance, if charging technology improves substantially, where you can charge your vehicles much quicker and at much lower cost, that could facilitate adoption of electric vehicles, or if there's a surge in oil prices, right? Because that's an inverse relationship. If gas prices increase, then it makes it more attractive to purchase electric vehicles. But one of the big positives in the current administration has been that fuel prices have decreased meaningfully. Not for the reasons you would like for fuel prices to decrease, but it's because macroeconomic growth worldwide is slowing down. So demand for fuel is slowing down, and that's creating lower prices for fuel. And so that's an additional headwind for electric vehicle companies or companies that rely on the growth of electric vehicle sales to generate revenue and profit, like ChargePoint does. So ChargePoint now has over 352,000 ports under management. Over 35,000 are DC fast chargers, and over 122,000 are located in Europe. With their roaming partnership, they enable access to more than 1.25 million charging ports globally. One good news item for ChargePoint stock investors is US tariffs are only going to minimally increase their cost of goods sold. They expect their cost reductions to exceed the impact of the current tariff. Therefore, they still expect margin improvement in the later parts of this year. And that's good news for ChargePoint stock investors. The management team also says that EV adoption continues on a steady upward trajectory, a trend which has held for more than a year. North American EV sales were up 16% year over year in Q1. In Europe, EV momentum rebounded strongly, with the same data set reporting 22% EV sales growth year over year for Q1. So while they are up 16% year over year in Q1 in North America, that rate has slowed down since then. And also, as a percentage of overall vehicle sales, it still contributes a small fraction of the overall sales of vehicles in North America, especially here in the United States. So the industry is growing for sure. There is an increase in electric vehicle sales worldwide, especially in regions like China, where there's strong government support for electric vehicles. And it makes sense for a lot of consumers because the price of these electric vehicles is also affordable. Here in the United States, you don't really have very many affordable options of electric vehicles available. Starting prices are around $40,000 here, whereas in China, you can get electric vehicles closer to $10,000, signaling the huge divide in affordability between the two regions. This document I'm reading from is ChargePoint's first quarter fiscal year 2026 earnings call transcript. I've made this document available for my channel members. You can see the link in the description for all the benefits you get for joining our channel, and you can join for less than $5 a month. All right, so to update my recommendation for ChargePoint stock, what do I think about this company today? Well, I have the stock and I upgraded the stock to a hold, as I mentioned about a month ago. And today on August 18th, I updated that recommendation. I still don't think investors should be buying this stock. And in my opinion, the stock is closer to a sell than it is a buy. But I have it rated as a hold because the valuation has gotten to such a low level that if the company can manage to withstand some of the headwinds in the near term, longer term, there could be innovation in the industry that could make it more attractive for folks to purchase electric vehicles. There may be some innovations in manufacturing, in battery technology, etc., that could drive down the price of electric vehicles, which would increase adoption, and that would be great for ChargePoint stock investors. So at current prices, it has some upside, although I think there are many, many better companies to buy than ChargePoint at current valuation. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.